Hi, my name is Ben Walker and I'm working here today with Promise Yourself to bring you fair, impartial guidance on all the things that we're just not taught at school. For example, buying a house, deposits, mortgages, renting, sharing a house and budgeting, all that kind of stuff that you just don't really learn about. And today I'm talking about the different types of mortgages. Now, a mortgage is essentially a loan that you take out when you want to buy a property. When you take out a mortgage, you normally have to put down a deposit of around 5% and upwards from there, but there are other options. For more information on deposits, go to my deposit section, which will be released very shortly. Now, there are two main types of mortgages. There are repayment mortgages and interest only. Now, a repayment mortgage is essentially when you're paying down the balance of the loan the entire way through the full term. So when you get to the end of the term, you actually have nothing left to pay. Now, the other type is interest-only mortgages, and this is where you only pay the interest that's earned on the mortgage. So the value of your mortgage will stay exactly the same over the full term, but when you get to the end, you still have to pay off that mortgage. It's not just free money. So you have to have something called an exit plan, which essentially means that you'll have a plan at the end of the term to pay off that money. Now, within these two main sections, there's even more types. There are four main types of these kind of mortgages. There's fixed rate, offset, discount, and tracker mortgages. Now, each of these has their own different advantages and disadvantages, so I'm going to run through these quite quickly so you guys get a nice brief idea of what each of one offers you. So the first type I'm going to talk about is fixed rate mortgages. Now, with fixed rate mortgages, essentially all it is the interest rate on the mortgage is fixed for a certain amount of time. That's like set down in the contract. This way you know exactly how much your interest is going to be, so you know exactly how much you have to pay off. These interest rates can be fixed for anywhere between 2 to 5 years normally, and after that they go on to the standard variable rate of your lender. Now, normally the standard variable rate is quite a lot more than whatever the fixed rate might be. And as each lender picks its own SVR, you never really know how much you're going to be paying. So once you get to the end of the fixed rate term, what you can choose to do is to remortgage with your lender or even with a completely different lender, which basically means that you can have another fixed rate mortgage and then another one, so you know exactly how much you're going to be paying, and that can end up saving you quite a lot of money. Now, actually what you can do is 6 months before your fixed rate period ends, you can already start the process of remortgaging, which means that you can be well prepared in advance, and it's great for peace of mind. Now, the next type I'm going to talk about is the tracker mortgage. This is when your lender uses an external rate, for example, the Bank of England interest rate, and sets their rate off that one. This basically means that if the Bank of England rate is 2% interest, then your lender might set your interest 2% higher. So if the Bank of England rate goes up, your interest rate's going to go up. If the Bank of England rate goes down, your interest rate will go down as well. Now, that sounds great because the Bank of England rate is essentially in line with what's going on with the world, but it can have its disadvantages. Like I said, it is variable. You never really know exactly what you're going to be paying. And also, quite a lot of lenders put collars onto their interest rates. So this means that if the Bank of England rate is at 3% and you're paying interest at 5%, but then the Bank of England rate drops to 1%, your lender might have a collar, which means that you can only pay the minimum of 4% interest, which means that you're losing a little bit of money there because your interest rate's not going to drop down as much as it would have. So it's really important to read exactly what's going on with your mortgage term if you've got this type, because you really want to know what's going on basically. The next type I'm going to talk about is discount mortgages. Now, you may have remembered I already mentioned the standard variable rate of the lender. Now, a discount mortgage is when they take their standard variable rate and then they discount a little bit of that, and that's what your mortgage will be. So if the standard variable rate for your lender is 5%, you may have a discount mortgage which takes off 1%, so your interest rate will be 4%. But like I said, the SVR, it goes up and down. It's completely variable and the lender decides its own. So if you're paying 4% interest with a standard variable rate 5%, that could go up to 10%, and then you're paying a huge amount of interest then. So if the SVR is staying constant throughout your entire mortgage term, it can be a very, very attractive option, but there's no guarantee. So if the SVR starts off very, very low, and you think, you know what, that's a great interest rate, I'm going for that, it could jump up at any time. So it could be high risk, but it could also be high reward. Now the final one I'm going to mention is offset mortgages. This is when you have money set aside in a savings account and you can actually link your mortgage to that savings account. So if you have a mortgage of £100,000 and then you have a saving account with £20,000, these are then linked. So instead of paying the interest on the 100,000, you'll be paying an interest on the 100,000 minus the 20. So you actually only pay interest on the £80,000. Now this can be a very, very attractive option because at the end of the day, you'll be paying less interest. But with some of these savings accounts, you will not actually be earning interest on that £20,000. In this case, it might actually make more sense to just put the £20,000 into a proper savings ISA. And if you want to learn more about that, feel free to check out the accounts page I'm going to do. So it could make more sense to put your money aside somewhere it's going to earn some interest and then just use that interest you earn to pay off the interest that you'd be paying extra on your mortgage. Again, it's all about knowing exactly what you're getting yourself into. If you're not sure, the best way to go is to ask a financial advisor or someone who just knows a lot about the subject, and they can definitely help you out and steer you in the right direction. But at the end of the day, it all comes down to what you are really looking for. Now, there are some factors that can affect the type of mortgage you can get and how much you'll actually end up paying on this mortgage. The first of these, and it's a big one, is how much of a deposit you can afford. Now, the bigger the deposit you have, the smaller your mortgage will actually be, so the quicker you can pay it off, or the smaller your repayments will actually be. This could end up saving you quite a lot of money, so it's well worth taking that extra time just to save up a little bit more, because as well as that, saving you the money, the bigger your deposit, the more likely you are to get favourable mortgage terms from your lender. Again, that's not a guarantee, but if you have a bigger deposit, you're more likely to get better terms. Now, if you can't save up for a big deposit, and if you can actually manage to get 5% together, then you could qualify for some government schemes. There's Help to Buy, Right to Buy, Shared Ownership, and there's a non-government backed Help to Buy scheme as well. Now, these schemes can help you increase your affordability, so your lender will look at you much more favourably, you get better terms, and it can end up saving you a whole chunk of cash. Now, another important factor is actually the type of property you're trying to buy. Each lender views different property differently. So if you're trying to buy a house, a flat, a shared house, it all depends, okay? So make sure you're going for the right lender for you and your property and your circumstances. You don't want to rush into anything. Don't be afraid to shop around. Now, the final thing that can have a massive impact on your mortgage is the kind of terms that you want. That's how long your mortgage is going to last, how much you want to repay a month. These can all have massive impacts. For example, if you're trying to do a 10-year mortgage, then your repayments are going to be quite a lot bigger per month compared to, say, a 25. You're going to repay it much, much quicker. Now, this means that you'll actually be paying less in interest. So in general, as a whole, the mortgage will end up costing you less, but you'll just be paying a lot more every month. And of course, the opposite is true for a longer term of 20, 30 years. So make sure that your circumstances provide you with the opportunity to actually pay off your mortgage. Hopefully you've learned something from this video. If you're still not sure, get in touch with people who are. You need to talk to financial advisors or people who just generally know a bit more about this than you. Don't be afraid to ask questions, learn as much as you can, and keep an eye out for all my other videos that will be going out there soon. Thank you very much.